CPI dropped again, but with Congress on mute, don't expect a happy ending. Inflation's cooling on paper, but shelter costs are sky high, food's quietly creeping, and the Fed's hands are tied. Without spending cuts from Congress, rate tweaks won't fix the core problem. And if a recession hits, expect another stimulus flood. Watch the full video, because this isn't the victory lap the headlines make it out to be.
Gary, to kick it off, really excited this week about this issue. We're talking CPI. The CPI fell. Where you're saying, hey, Congress is not going to help in any way here. Thing number one, Gary, CPI falls, but is still above target.
All right, Rob. So for people who are new here, CPI stands for the Consumer Price Index. When people talk about inflation, they're typically referring to the Consumer Price Index. If someone says, hey, inflation was up 2% or 5%, they're referring to the CPI. The April number came in at 2.3%. Now, that's still above the 2% target, which I will argue is 2% too high, but it's also the lowest figure in years. So when you have a decreasing rate of inflation, so inflation is still increasing, but at a slower rate, that's the second derivative for all you calculus fans out there, we call that disinflation. And 2.3% is some pretty good disinflation. The core CPI, that's the number that excludes food and energy, was a still sticky 2.8%. That's not as good. If we go into some of the details, food was up 2.8%, which is higher than it's been recently, but I still think is understated. I think, if your grocery prices are only up 3%, put it in the comments, let us know. I'd be shocked. Food away from home was up almost 4%. That's a pretty big number. That's leading more people to eat at home. Good for Walmart. That's been helping their food sales. Energy prices were down 3.7%. That continues to be a tailwind. People are enjoying lower gasoline prices. Service prices, which have been sticky for years and a giant problem for Jerome Powell and the Fed, were up 3.6%. That's partly driven by increasing nominal wages, which isn't necessarily a bad thing. But we do still have a bit of a wage price spiral going on where people understandably want to be paid more. And what that does is that increases costs for business. They increase their prices, and then consumers say this is getting expensive. They go to their bosses and say, we need to get paid more. So when people talk about a wage price spiral, that's what they're referring to. There is some of that going on. Shelter, which is the fancy word for housing that they use in these reports, was up 4%. That accounted for more than half of the month's CPI increase. In my opinion, I think it's going to take either lower interest rates or a recession to bring down housing prices, although the housing bears will note that there are certain markets where housing prices have started to decline, and it's been really rough for the people who leveraged up and bought a bunch of homes that they were using for Airbnb. In certain markets, those are not doing well. I think Amy Nixon on X has done a really good job of covering that. She's been more bearish than I've been, but I think she's worth listening to on this topic.
Yeah, definitely. What's Amy's handle, Gary, for everyone listening?
You know what? So that's a great question, and I don't know. I have notifications enabled for her, so I don't know. But yeah, Amy Nixon. She's. I think it's something about running in Texas runner, something. You know what? Look it up, but she does really good work on this. The other person who is really bearish on housing but does phenomenal work in the housing sector is Darth Powell, which is one of the great pseudonyms on X. He's a terrific person. He and I disagree on Bitcoin, but I think he's done really good work on housing. So check him out, Darth Powell, with a great username, and he's got a hilarious photo for his image as well.
Love it. That's great. Gary, with this news, right? Obviously, everyone looking at what's happening with the interest rates. Are they going to be lowered? Is now, or should the Fed now lower rates? What are your thoughts there?
Yeah, so I don't think, first of all, if I were the Fed, I would not lower at this point. I don't think they have inflation under control. People are understandably excited about the lower 2.3% print, but it's not done yet. They do not yet have inflation under control. The risk is that they lighten up again and end up with higher 10-year rates as the bond market prices in expected increases in future inflation. In my opinion, there's very little the Fed can do right now without spending cuts from Congress. That's something I don't expect to see, despite a lot of the clickbait headlines saying otherwise. I'm a big fan of Doge, but as predicted, they're not going to get $2 trillion of cuts. I think it would be great if they did, but it's clearly not going to happen. Inflation is being caused primarily by congressional overspending, and they're going to flood the economy with more stimulus funds if we have a recession. So be prepared for more inflation. On the Federal Reserve side, if the Fed raises rates, and they're not about to do that, that will, help get inflation under control, but it will be really rough on the economy, which is starting to weaken a bit. But if they lower rates, which President Trump wants and a lot of equity investors want, we're going to see a bear market in bonds. And people might say, well, why does that matter? Who cares? I'm not invested in bonds. Is that an issue? And the reason it is an issue is because Treasury Secretary Bessent has to refinance $7 trillion this year. If they don't get the 10-year down, it's going to be really expensive. We could be looking at $1.5 trillion, $1.6 trillion of interest expense this year. That's a big number. That would put a gigantic hole in the budget. It's something we don't want to see. And so remember, prices and yields move inversely in the bond market. What that means is that if the Fed lowers the Fed funds rate and the bond market expects higher future inflation, it leads to a bear market in bonds, meaning bond prices come down and yields go up. And for those of you who are waiting for mortgage rates to come down before you go buy a home, and you have my sympathy and good wishes, you also want the 10-year to come down. So, we're all hoping for actually higher bond prices and lower yields, and they're not going to get that if the Fed cuts. So in my opinion, as much as the issues that we've had in recent years have been partly due to Jerome Powell and the Fed making bad decisions, he's doing the right thing right now to ignore President Trump's request for lower rates and just sitting right where they are. And that's what I would do if I were in that.